Hello to everyone. Today I am here with my channel titled Financial Reality. This channel is initiative with the objective to enhance the knowledge, finance-related knowledge of financial and non-financial professionals and also cater the need of academia. My today's topic is Finance for Non-Finance Professionals, Part 1. If you are interested to have update videos on banking and finance related topics, please do subscribe my channel. Again, its title is Financial Reality. Introductory section. In the first part, we have covered Introduction to Finance, key financial terms, define financial statements overview, types of auditor's report. What do you mean by the finance? Money used by a company, provided by shareholders or by loan. We have two sources in order to inject the money within the business. One is shareholders, means owners contribution, that is called capital equity, and other one is by borrowing from others. Others can be from family and friends, from associate companies, companies directors, and from financial institutions. That part is called capital debt. Other definition is money, resources of a state, company, or a person. Money resources means all type of asset owned by the business that include intangible asset in the shape of investment, in the shape of bank balances, and tangible asset in the shape of building, land, equipment, machinery, furniture, fixtures, vehicles, etc. One more definition, provision of money when and where required. A good finance manager always keep the provision when and where required. Means in order to fulfill the need of the business. It can be short term. Short term can be in the shape of working capital to meet production needs, running finance to meet day-to-day expenditure, etc., and long-term need in the shape of induction of any new asset for the business. Fourth one is the art and science of managing money. So these are few of the definitions related to the concept finance. There are few financial terms. Capital employed, as I have already discussed, capital equity, the money owned by the owners of the company. It can be in the shape of common stocks or common shares, retained earning, reserves, etc. Capital debt is the part of borrowings from others that include family and friends, directors, associate companies, and financial institutions, etc. The sum of capital equity and capital debt is called capital employed. Retained earning is the part of the profit that reinvest within the business. Leverage. Leverage is the part of debt. It is considered to be the loading for the business. If a company is 100% equity based, that is called company having zero leverage. If the company having 20% debt and 80% equity, that is considered to be low leverage company. If the company having 50% capital debt and 50% capital equity, that is called moderate leverage company. If the company having 80% debt and 20% equity, that is considered to be the high leverage company. Now point arises, either the leverage is good or bad. It depends. If you have borrowed the money for revenue generating assets like machinery and equipment. Those assets will generate incremental cash flow and may pay their financial obligation from the revenue those assets are generating. Short-term and long-term loans. Short-term loans are basically to meet the working capital need for production, running finance need, for day-to-day expenditure, and further seasonal loans that is against the crop like wheat, rice, maize, and those uh, basically protect used for the production throughout the year. Term finance is against the capital expenditure. Capital expenditure include all type of assets. Internal financing and the external financing. Internal financing is from your directors, associate companies. External financing can be from family and friends and from financial institutions. Financial mix is very interesting topic. Every company make a policy for the financial mix. How much part of the debt and how much part of the equity they use to manage. For example, a company decided that we will not go for capital debt more than 60% of our capital employed. So that ratio of the 50 is to 40 is called financial mix. Primary market is the market from where an instrument is first time floated and the money directly become a part of company's capital employed. It can be in the shape of capital equity. If you are floating your common stocks, then it will be a part of capital equity. If you are going to float the bonds, then it will consider to be a part of capital debt. Secondary market where those instruments are traded. For example, bonds are traded in the stock market and shares are also traded in the stock market. Now, this activity is not a direct part of the company. The existing shareholders or existing bondholders go for the sale and purchase of those instruments. Money market is the market that deals with the liquid securities and with the securities having the maturity period not more than 1 year. And capital market is deal with the transfer of assets like stock market and also deal with the financial institution for financial instruments having maturity period more than a year. What do you mean by what is financial asset? Financial asset represent claim against the income and the asset of the individual and institutions issuing those claims. Now, for example, you have invested the money in the bank deposit. That instrument is considered to be your asset, and the profit generated against that instrument is considered to be the part of income. So the claim will be established against both asset in the shape of instrument and income in the shape of profit. There are three major categories of financial assets. Money. Money is, or money or the bearer instrument is considered to be a part of or considered to be the asset by possession. If you have cash in your hand, you have the bearer instrument, your ownership will be established by possession. That instrument is considered to be the investment in bonds, the bank deposit, etc., notes payable. These are the part of that instrument. Their claim will be established by title. Similarly, equity instrument, if you have invested in equity instrument like equity mutual fund, shares. So these are the major category of the financial asset. Financial statements, introduction and overview. What do you mean by financial statement? Financial statement are written record that convey the business activity, the financial performance, and the health of a business, person, or entity. Now, financial instrument, basically, they record each type of the business entries or the activity. Business financial performance is measured by its profitability, its obligation to meet financial obligation, and health. Health is measured based on the relation between the company's assets is to its liabilities. That we are going to discuss in the coming lectures as well. These reports provide a snapshot of our business financial situation, result of operations, and cash flows. That we will also discuss in the coming lecture. Now here we have the financial statement and overview. First of all comes auditor's report. It's very important because most of the financial analysts used to ignore auditor's report. Thereafter, balance sheet, profit and loss statement, routine earnings statement, cash flow statement, and every variable as a part of balance sheet and profit and loss statement having detail as notes. What do you mean by the auditor's report? In a document containing the auditor's option on whether a company's financial statement comply with the required accounting standards and are free from the material misstatement. So auditor report clearly mentions either all the material within the financial statement is fairly presented or not. The auditor report is important because bank, creditor, and regulator require an audit of a company's financial statement. Types of auditor's report: unqualified audit report, present the fairly in all material respects. So we always need an unqualified audit report. But we also have qualified reports as well, because all the public limited companies having mandatory for them to have audited their account. So in that case, sometimes it happens the auditor is not having satisfaction on the material, so he or she qualifies the report. Qualified audit report contain misstatement material. The auditor will mention in this report that this financials contain misstatement material. Adverse audit report, it is also a type of qualified report, contain gross misstatement and or fraud. Disclaimer audit report, unable to form option due to insufficient or unreliable. So it is the end of my lecture, first lecture on finance for non-finance professionals. Again, if you are interested to have update videos on banking and finance related topic, please do subscribe my channel. See you very soon with my upcoming video. Thank you very much.